How to understand financial ratios. Have you ever wondered how numbers can tell us about a company's financial health? Understanding financial ratios is essential for anyone interested in business or investing. These ratios are numerical calculations that compare different pieces of financial data from a company's financial statements, like the balance sheet and income statement. They help us measure a company's performance and risks by revealing relationships between key figures. To grasp financial ratios, we first need to know what they representing. Financial ratios express relationships between numbers, turning raw data into meaningful information. For instance, a ratio might compare current assets to current liabilities to show liquidity or net income to sales to measure profitability. There are four main categories of financial ratios. The first category is liquidity ratios, which assess a company's ability to meet short-term obligations. A common liquidity ratio is the current ratio, calculated by dividing current assets by current liabilities. A ratio above 1 indicates that a company has more assets than short-term debts, showing good liquidity. Another important liquidity measure is the quick ratio, which excludes inventory from assets to focus on the most liquid assets. Next, we have activity or efficiency ratios. These ratios measure how well a company uses its assets and manages operations. For example, inventory turnover shows how quickly a company sells its inventory, while receivables turnover indicates how fast it collects money owed. High turnover rates usually signal efficient management. The third category is profitability ratios, which evaluate how well a company generates profit relative to sales, assets, or equity. The gross margin ratio shows the percentage of revenue left after covering the cost of goods sold. The profit margin reveals how much profit remains from sales after all expenses are paid. Return on assets and return on equity indicate how effectively a company uses its assets and shareholders' investments to generate earnings. Finally, we have leverage or debt ratios. These ratios indicate how much debt a company uses to finance its operations and how well it can manage debt payments. The debt-to-equity ratio compares total debt to shareholders' equity, showing financial leverage. The interest coverage ratio measures the ability to pay interest expenses from operating income. To truly understand financial ratios, it is helpful to learn the formulas and what financial statement numbers they use. Interpreting the results in context is also important, as what is considered a good ratio can vary by industry and company size. Comparing ratios over time can help identify trends, and looking at them alongside competitors can provide useful benchmarks. Business owners and investors use these ratios to make informed decisions about a company's financial stability, ability to pay debts, and overall profitability. Ratios can also highlight potential problems, such as excessive debt or slow inventory turnover. In everyday life, financial ratios illustrate how numbers relate to each other, telling a story about a company's financial condition. They transform raw data into a language that reveals patterns, strengths, and weaknesses. This cultural and practical significance of numbers plays a vital role in guiding important business decisions. Understanding financial ratios can empower you to make smarter choices in the world of finance.